Hello and welcome to this video on market manipulation templates for short-term trading. And this is going to be the third part of the three-part series. It's kind of like a series on the module, which is lesson 3. This was the main content I was supposed to produce, but I wanted to go over top-down analysis first before getting down into this. And essentially the reason why I went through the top-down analysis and just rehashing some of the concepts already discussed on module 2 is because that really plays a significant role in terms of anticipating your weekly range profile. Now, like I've mentioned before, if you don't have an understanding of where price is going to, then it's going to get very easy to get manipulated by the marketplace. Because what the market does a lot of time is the market will engineer open flow liquidity, and you can determine what open flow liquidity or how it is being engineered by understanding the higher time frame premise. Without a clear understanding of the higher time frame premise, you're not going to be able to fully grasp what open flow liquidity is being engineered. You're not going to be fully able to grasp essentially the manipulation that will occur in the marketplace. And what would happen usually is you usually get caught off guard by conditions like this. So that's how we had to go through the top-down analysis and rehash a couple concepts from the higher time frame module, where we talked about understanding a clear understanding of macro price delivery, and then that gives an insight into how the lower time frame should form. Okay, now with the lower time frame, we are more concerned with the narrative. And when we say narrative, I'm specifically talking about narrative in how price should deliver in line with high time frame delivery. Okay, so once you have a bias, or once you have where you think the market is going up or down into, the lower time frame will create narrative that will trap traders the opposite direction and then run for one direction. And this phenomena is what we'll call engineering open flow liquidity, which I think we've talked about on the liquidity video on module 1, where we talked about liquidity pools. It's called engineering open flow liquidity. Now, I think this is supposed to be open flow liquidity. Now, classically, what a lot of traders, structured traders, supply and demand traders, and the whole lot of them, when the market is doing something like this, let's just do a very quick drawing. Okay, I think this tool makes more sense, so I'm gonna use this tool. If the market is going higher and goes lower and trades lower, everyone's going to expect that as we trade from here, the market should see a continuation of the downtrend and see another leg lower and see another leg lower. That's the classic anticipation. But at what point is this run lower instead a run unstopped and a reversal to go long? And now we're going to talk about something called time and price. And when we get down into day trading content, we're going to talk about this even more, which we're going to tie back into the short-term trading module. So I don't want to go fully in depth into that, the concept of time, because it will become more prominent as we get into the day trading module. I'll tie everything back into this current module for short-term trading. But what really helps you understand overflow liquidity being engineered is the time of the week, the time of the day, in the context of higher time frame price delivery mechanism. Now, it's not going to make a ton of sense at the moment, but I'll show you shortly how you can utilize this. So the chart I'm using here is the chart from last week's price action, something we called and anticipated in terms of price delivery. And what you can see here is you can see the market. It's kind of like in a small little squeeze, or what you call consolidation, because it's not seeing a ton of expansion higher, but it is seeing small little ranges. And then on Thursday, we saw a larger inform going into Friday, where we saw a down close. Now, if we went on the lower time frame without even doing anything on the higher time frame, okay, without going into higher time frame or doing nothing, if I did something like this, the lower time frame. What's to say that this is not continuation short? Because we've seen a run on buy stops, we've seen a reversal, we've seen a retracement back up into fair value gap, and we're anticipating continuation lower for sell stops. This is what the classic retail would expect, and not only retail, also quote unquote institutional traders too. All right, because if you went on Twitter last week, and I was actually talking about this on the evening commentary, that a lot of traders are expecting lower prices on euro. I'm not. Okay, and here they'll look at stuff like this and they'll say this is a fair value gap, and they want to see the market run lower. So I'm just using basic institutional understanding of, in terms of reading price. So prices trade up into the fair value gap. They want to see lower prices. They see a break in structure. And what would you expect typically? That as we trade up into this bearish block, we should see a sell off. Correct? Yeah, that's what you expect, because we have equal lows down here. And we have triple bottom down here. So that's a retail low. And we want to see the market go and run out sell stops. But does it run out sell stops? It does not. It just screams higher. Now you're confused. Why did the market trade like this? The reason why, and this is the shortcoming of a lot of institutional traders, they actually skip out the higher time frame because they feel like for moves to form or for patterns that they're familiar with to form on the larger time frame, it takes a lot of time, and they feel like they cannot wait for that period of time to wait for just one idea to form on the higher time frame. So a lot of times they prefer to only just zone in on the lower time frame without understanding the context of higher time frame price delivery. Now we're going to actually sort that out on this video. You don't need price to you don't need to wait for weeks. I actually lost my train of thought there, but you do not need to wait for weeks or days for a setup to form or for a pattern to form on the higher time frame. There are two key elements here that you need to understand, and once you can understand that with the higher time frame, you already know what you're looking for narratively on the lower time frame and then how it should paint. Where is high time frame price delivery coming from? Where is higher time frame price delivery going to? That's the only question you need to ask yourself. If you can figure out with a degree of probability where it's coming from and where it's going to, you've done the major work in terms of a direction premise, because that is what a direction premise is all about. It's all about understanding where price is going to. But for you to understand where price is going to, you need to understand where price is coming from. Now, what do I mean by where price is coming from? What are the questions you should be asking yourself when you ask yourself, when do your analysis, where's price coming from? The main thing you want to ask yourself is where price is coming from. Is that institutionally supported? If that's institutionally supported, then that should be in line with a quarterly shift or a macro price delivery. So where price is coming from, is that institution supported? What are the concepts or tools you can use to identify if a swing initiation or an impulse price swing is actually institution supported? By bringing together the elements we talked about, which is open interest, COT, seasonals, and SMT at that higher time frame level. Like, if you're not doing these on the lower time frame chart, you're doing it on the higher time frame, because the lower time frame you're more concerned with narrative and how that forms instead of the range you're expecting or anticipating for the higher time frame. Okay, so now let's do this with euro. Actually, before we even go and use this price action, let's zoom out a little bit and talk about swing progression. Now, classically, what you have with swing progression is you have what we call your point of origin, and that point of origin would be a level of high time frame discount or premium. In this example, because we're looking at bullishness on price, we're looking at an high time frame discount. Okay, high time frame discount is here, and almost all your reversals will form around these levels. And what you would get typically in price is the market trades out into high time frame discount, maybe you have a Terasup long, and the first run out of that high time frame discount that breaks market structure is what we'll call the impulse price swing. Okay, it is the impulse swing away from our anticipated support. And this is also what I call institutional sponsorship, which is evidence of smart money participation in price delivery. Okay, once we see not just slow, we want to see fast one-sidedness in price. All right, so this is where we go into a little bit of more detail, and here we're going to talk about characteristics. Characteristics. My spelling is really bad today. Of institutional sponsorship. All right, so what are the characteristics of institutional sponsorship? And here we are concerned with speed of delivery, one-sidedness of delivery. Why is this really important to us for institutional sponsorship? Because remember, when these institutions accumulate positions or distribute positions at these key high time frame levels, right, the market is not moving as a result of the supply and demand at that high time frame level. Okay, price is moving because the algo starts to drive the market up into a level where these institutions are now currently in open flow liquidity. So open flow liquidity means they are currently have open risk in the marketplace. They need a point where they can exit their positions, and what's getting price to the point where these institutions can exit their positions? It's going to be the algo. Okay, and usually when the algo is delivering price, it sometimes does not do so efficiently. Okay, a lot of times, if there is recent institutional participation, you would see in it, and you've seen that on the live sessions, whereby I'll say, all right, we have an entry now, and what I want to see in prices, I want to see the market start to create inefficiencies or fair value gap, because that shows to us a willingness to want to displace for liquidity, right? And they all tie together. The origin and end target liquidity, they're all correlated, because if institutions are accumulating at the point of origin, they need an exit liquidity to exit their accumulated positions at. Otherwise, you're going to be stuck in the position forever. So they need counterparty liquidity to pair against. That's why we need to understand price origin, number one, and then understand price objective or target, which is number two. And everything in between is simply going to be a gyration between premium versus discount on the high time frame level, and we can use that to frame our lower time frame anticipation, if that makes sense. Again, this is why you don't need to wait for days or weeks for a setup to form in the daily time frame. Every single day you can go into price knowing what the most likely general liquidity is, and you can trade your lower time frame in alignment with that. All right, so with this, we have the first swing rate, and this is usually what's called the first swing rate, which is the impulse swing out of the high time frame level or discount in this example. And then you have your second swing rate, and usually this will be a measured move of move one sometimes, and that usually is going to be your 200 Fibonacci extension level or one standard deviation of this range. All right, a lot of times it will be a measured move, and this is where, if you look at the classic retail textbook, they talk about the A to B, C to D extension levels, and this is where it comes from, because the algo will make a lot of times almost the same in terms of pips. Will make almost the same leg in price, right? So make one leg higher, and they'll make the equivalent. Once it's done with the retracement, we'll make the equivalent and make another leg higher, and usually that'll be 200 Fibonacci extension level. And then you have your third swing rate prior to your objective liquidity, and the objective liquidity is going to be something up here, which is an hourly time frame premium in form of a bearish block. Oftentimes it could be a rejection block or an old high, and this is where the market ultimately is reaching up into. Now usually the third swing grade is usually the fastest, along with the first swing grade. Now the reason why the third swing grade is the fastest is because price is aggressively reaching for liquidity. So the closer we are to liquidity objective, the faster the price level we're going to see. So what that happens there, that is also psychological play in price, right? So if you're short inside this entire range, your stops will be resting above the most recent parent price swing high if you're a fund level. Now obviously if you're retail and you're shorting something like here, your stops are going to be above the most recent short-term high. But for the funds, because they can hold positions for longer periods of time, usually their stops would be resting above old highs or a rejection block, because that's where the volume of liquidity is done. And the market, by running for that level very fast and aggressively, it does not give them a chance to exit their trade at, let's say, break even or a slight bit of a profit. Okay, the speed and delivery is a psychological play on open flow liquidity to suck that in and give institutional participants down here a chance to book profits against weaker sellers in the marketplace. I guess it's all a psychological play. But again, you have your first swing grade, which is the initial impulse swing of a range. You have your second swing grade, and then you have your third swing grade. And the distance between your anticipated support, high time frame support, and your objective usually is what we'll call the equilibrium of the range. And that's where usually the market will go into a little bit of an extended consolidation. Now, not every time, but oftentimes it can do this. A lot of times you can go into an extended consolidation, chop around, and these are conditions where you don't trade as often or you sit it out altogether, which I do teach you this on the evening commentaries, the live session on anticipating this kind of profile on the daily range, and you can also apply this to lower time frame range. All right, so again, going back to what we talked about in terms of anticipating daily order flow, all you need to know is where is price coming from and where is price going to, and you need to confirm that where price is coming from is an institutionally supported low or high by using the tools we talked about. What's the commercial program? Is it a commercial buy program or a commercial sell program? What's open interest indicating? Okay, are they net long or are they net short? What is SMT saying about accumulation versus distribution? Is it confirming that daily high or that weekly high or that daily low or that weekly low? These are the questions you're asking yourself. And once you can define where price origin is on the higher time frame, and you can identify where the general liquidity is on the higher time frame, you've solved 80% of the work when it comes to the direction of premise. And all you need to do is you need to go into lower time frame looking for this kind of array to look for expansion from. Now remember, a lot of the explosiveness in price intra-week will form around key high time frame levels, and that's why it really is important to have your key high time frame levels on your chart. So let me show you something real quick. All right, let's go on Twitter, and so I made a post not recently, that was like about an hour ago or 2 hours ago, right? And let's go to profile. And I'll show you my swing position on cable. That's from this, from here, which we discussed on, I think we discussed that last week. Yeah, so go on to watch even commentary last week. Now, I did not day trade on cable, but I swing traded on cable, and I was talking about swing trades, like for swing trades all the way up to this liquidity pool up there. And if you notice, I talked about price capping off the low of the week at this specific level. So it's all recorded on the evening commentary before the fact. Okay, when this candle formed, when this large wick formed like this. We talked about this line here capping off the low of the week and seeing expansion for buys liquidity, which is around where you see my execution at. Okay, my execution was somewhere around there because I was using lower time frame to get in sync with my swing trade. All right, so that level is a weekly time frame. Sorry, not a weekly time frame. Sorry, that's a weekly PD array. Actually, it's a weekly discount array. Okay, so the market trades down into that weekly discount array and sees massive expansion. Now let's go actually into a lower time frame and see the delivery from that level. All right, so if we go into the lower time frame, you can see initially as we trade down to the level on Monday, we had a little bit of an impulse price swing, and then we had a retracement going into Wednesday and saw another leg higher. Now watch this. The initial leg from here to where we have the second expansion is relatively the same. All right, I can see where price caps off the high and sees the retracement lower, and guess what happens the next day? We see a continuation higher. Okay, we have another leg higher with this. Now, if you take all of this and you go out to a far time frame, from here where we have the initial impulse bar swing, then we have the second leg higher, we have the third leg, you're going to see it aligns with what I just talked about in terms of the swing rate progression. Or if you looked at the overall delivery after the run on sell stops here, you have one leg higher. Okay, price runs down here, consolidates a little bit, and then starts the leg higher here. So we have one leg higher here. This is your first swing rate. Okay, because this is where the expansion starts from. I'm not using this low here because it was a bunch of consolidation. This is where our actual expansion starts from. Breaking a major short-term high here. Okay, and then this is your second leg higher. All right, so you have first swing rate projection, second swing rate projection, and then you have your third swing rate projection, which runs up into the higher time frame objective. And this is classic price delivery. All right, now why did we see so much of a retracement here? That's because we were trading at the equilibrium of the overall trader range. Okay, so from that high to the low here, this is equilibrium. I remember what I talked about. At equilibrium, see, look at how the market retests equilibrium again here. But I talked about how at equilibrium, the market will oftentimes see wild retracements or sometimes go into extended consolidation. Now, it does not actually do that here. It does not go into an extended consolidation here. But a lot of times, that is more likely to be the case, like you can see on to your left. Okay, so to your left, we have, if I removed all of this upside on British pound, let me actually remove the session breaks because it is distracting. All right, so we have from this low here all the way up to the high up there. All right, so I'm gonna use this one, and I'm using this eye here because this was a stop run. All right, so usually when I see stop runs, I don't like using the stop runs. I like using the high prior to the stop run because the stop run was a run or it was a play on liquidity. All right, I think I talked about that on the previous video too. All right, so what's this? Which is nothing else. So we have this low here, which is target objective liquidity, and we have this eye here. I'm not using this one because that's a stop run, and I'm actually using this eye. And you can see as we leave the initial expansion, we see speed and willingness in price to want to display slower. This is what we call institutional sponsorship, like I talked about. Okay, speed of delivery and one-sidedness of delivery confirms institutional sponsorship. Right, that's why I'll show you once I'm done with this part of the video. So you can see here we have speed of delivery and one-sidedness of delivery. That confirms that this is liquidity being targeted. So every time the market runs a short-term high, that's not a breaking structure. That's a run on stops, because this is liquidity being targeted. But if you don't know better, if I went to a 1 hour time frame and you're short-term trading on a 1 hour time frame and you don't know better, what would happen is you look at this and say, well, this is a retracement back down into bullish order block, we're looking for buys. Or after we've seen expansion from the bullish order block, I'm looking for a continuation higher. Guess what? The market goes and stops you out. Right? As soon as it runs above that short-term high, you're excited and elated that you're in profit, and the market just puts the brakes on you and completely reverses. And now the market trades up again, and you see this reaction from this bullish order block. Now you're excited that this is a continuation buy higher, and you're looking at this as a propulsion block, saying to yourself, okay, I want to see the market trade down into the propulsion block. By the way, this is London session. I want to see the market trade down into propulsion block, and then see continuation higher to at least try and clear out these equalizers, because you're thinking to yourself, these are relatively equalized, so I want to see the market trade up there. And guess what? The market just blows right through and runs for sell stop. Now you're confused about what's going on in price. All right, you say short-term low here, and the market retraces a little bit, and you're seeing consolidation, and you're thinking to yourself, okay, let me go in and go long, but it does not. And then on the final leg lower, you can see how fast it runs for sell side liquidity. Okay, again, the one-sidedness of displacement, unlike this one where it consolidates a little bit. Here, just know after the final run stop, okay, here it just runs straight up for sell side liquidity. And you would not, if you are trading inside this range, you would have gotten it wrong a couple of times if you did not know where the high time frame drawn liquidity is. And this is why I talk about the high time frame drawn liquidity being the context of your lower time frame price delivery. Now you are going to see, if I removed all of this and if I removed the swing rate and doing all the swing rate measurements, you're going to see that a lot of the explosive price delivery formed around key high time frame levels. So I think this is, okay, let me go and use a plain empty chart of British pound. Let's use forex.com. So I don't remove the my markings on the price that I use. Okay, I'm a little bit slow today too. I just realized. I apologize about that. I think for some reason, I am so tired. I don't know why. I'm not old, so it's weird. Okay, so now let's look at this front lower and see where the explosive delivery forms at. Okay, where do they form at? Already I can see on the far right time frame, I can already see very clear levels. But before we go even utilize far right time frame, let's watch. Oh man. Let us watch the daily chart. Okay, so this is a daily CB here. That is all a daily sell sign balanced by some efficiency. And as the market breaks below, we now have a propulsion block, because it is forming inside all of these 3 up candles, which is a bearish order block. Not these ones, because the bodies of these candles are inside this one. So this is our propulsion block here. So we're going to identify the mean threshold of that, and then we're also going to identify the opening price of the bearish order block. Again, I don't know what it looks like on the lower time frame, or at least I can't remember. I definitely trade this, but I can't remember what it looked like on the lower time frame. Again, we also mapped all of this out. So if you're thinking, oh, it's all line side, go and look at the commentaries. It's all in there. All of that is in the evening commentaries. All right, so we have this as our high time frame fair value gap there. And we're going to use purple for high time frame fair value gap. And we have our propulsion block here. Okay, so just a propulsion block here, high time frame fair value gap. And what we're going to do is we're going to go into the lower time frame. And let's see where the explosive moves comes from. This run on buy stops up into high time frame premium. And that's where all of this run lower starts from. And as we run lower here, we now have a daily propulsion block. Runs up into the mean threshold of the propulsion block. Now this is not valid. If I put up the session breaks, all right, so this is not valid because this run I is not valid because it is outside our time window. But you can see after a run liquidity and clear out liquidity, obviously we expect, if we, again, like I've mentioned before, if we clear a level of liquidity and we see price return back into the most recent range it expanded from, then we're expecting some retracement to clear out internal liquidity inside the range. Most of the time that's what price does. And you can see the market runs and clears out buy stop, but where is it doing that at? It's doing that at the mean threshold of the daily bearish block. And so what happens there? The explosiveness also comes from the mean threshold of that daily bearish block. Again, this is the 1 hour time frame, by the way. This is your short-term time frame. And then during the New York session, start of the New York session, the low of that bearish block, the opening price of that bearish block offers you another leg lower to clear out liquidity. And guess what? We see price return back into the most recent range. So what do we expect? We expect price to go and clear out some level of buy side liquidity, which it does here. Goes and clears out level of buy side liquidity on Friday after seeing multiple downside expansion. And then getting into Monday, see what the market does on Monday. So on Monday, we are in between the mean threshold of that daily bearish block and the opening price of that daily bearish block. But do you see any explosives lower? Excuse me. No, we don't see that. Why? Because it's a Monday, right? This is why I typically say, let Monday do its thing. Monday usually is going to be like the jitter swing for the week, just like Asia is. And you allow Monday to do its thing. And then go into Tuesday, boom, trades up there, and look at the strength and speed of delivery. And on Wednesday, trades up there, and again. So do you see how every lower time frame price delivery forms around these key high time frame levels? I can keep going back and keep showing you everything, so you understand the importance of high time frame price delivery, high time frame levels on lower time frame price delivery. Now, we can see this, and you can go on your charts. I don't need to go and keep showing you different examples or multiple examples of this happening on your charts. The better question you should be asking me is, why, Jin? Why are these explosive moves occurring around these high time frame price levels? Why? That's the question, right? That's the main question. The reason why, like I've said before, the funds and the institutions, they build in orders around key high time frame level. At these key high time frame levels, that's where there would be transactions. So when I say transactions, I simply mean provision of liquidity to the funds. And that's where you get institutional sponsorship, aka the algo displacing for the next exit liquidity. If there is a position being placed, or if there is a massive contract that is now currently active in the marketplace, that contract needs a level to be squared or needs a level to be mitigated, okay? Either profitably or not, but in this case profitably, because that's the way the market is engineered to work, right, for interbank traders. And these levels are usually going to be lower time frame exit points and overall higher time frame exit points. Now, we as short-term traders, we do not need these daily levels. We don't need to hold price for these daily levels to make money. All we need is we need a lower time frame liquidity in the direction of our target higher time frame liquidity, and that's all we need. Once we know where price is coming from. Now, if you look at this in cable again, if I go to daily time frame, I wanted to use your chart from last week, but I think this communicates the message even better. Now, if you look at cable like this out here, and you compare that with euro, right? You're gonna see here as euro is making a lower high. All right, as euro is making lower high, cable was making higher high there, and you have your SMT divergence. And we talked about why DXY should be bullish, and we talked about we utilized intermarket analysis with USDJPY, and we also utilized USDJPY and also USDCAD, and I think we also utilized COT data, I think, for that. All right, so we already knew that price was weak, and the moment we saw this inefficiency create, remember we're talking about this liquidity author. But I thought we called this inefficiency before it even actually happened. And then after it happened, we're talking about anticipating this target liquidity here. And what you can see is once we knew or figured out where price is going to, again, if I went to my Twitter and I showed you my screenshot, let's go back. All right. And you can see the executions I did with cable. The red lines indicates where I sold, and the blue lines indicates where I took profits at. All right, so I sold short, took profit taken. I sold short, took some profits. I sold short, took some profits. When was that break even? I sold short, took some profits. Sold short, took some profits. Sold short here, took some profits. Once I realized a trend that switched over, here I took the final profit of this swing trade down here, and then here I don't know what was going on here. But this was now a buy, and took some profits here, took some profits there, took some profits there. And all I was doing was I was just swing trading in direction of high time frame liquidity. And you can see at this point here, this is where I'm drawing attention to. Okay, this is where your attention should be drawn into. Okay, so this shorts here where I exited down here, and the remaining was a break-even position, and this one here was also done here, and I also bought down here and took some profits up there. I think it should show that. All right, now here was where it looked like it was a little bit of a mess, where I think I sold short, took a loss. Did I? Yeah, I did. Yeah. So I sold short here. I thought I sold short or I bought something. And the reason for that was just trying to figure out where the next strong liquidity was. Okay. And once we saw the displacement, we already knew what was going to happen next. And this is why I'm telling you about understanding price lever. You don't need to time the absolute lows or highs in the marketplace for it to make money. Okay, because that's where you get manipulated the most, and this is where also the institutions get manipulated the most. Okay, because only the central banks know where they're going to switch from providing buy-side liquidity to now providing sell-side liquidity, and then providing sell-side liquidity to then providing buy-side liquidity. Okay, so all you need is a confirmation of delivery, aka institution sponsorship, and a very clear draw on liquidity on the higher time frame. And then you have all you need to know on the lower time frame. Now you're looking for a lower time frame. As we get more into the module, we're going to talk more about time and price. But as you get into lower, once you figure out what the higher time frame is doing, then the only thing else you need is just time and price, and that will help you frame or pre-anticipate the manipulation before they actually even happen. And then the expansion in price. So hopefully this was an insightful video, and I will talk to you on the next lesson. Trade safe.